Hey, what's up, good people? Hey, on today's show, I got a special guest, my man Carter Cofield. We've had him here before, and it's more than just making money. It is what you keep and not what you make, right? If you're new to this page, go ahead and hit that like, subscribe, and notification bell, just like the prompter usually tells you. But I'm just going to bring him in. Carter Cofield, hey, man, go ahead and introduce yourself to the people.
Larry, what's going on, brother? Happy to be here. Carter Cofield, CPA. My job is to help your audience live tax free. So I'm happy to be here, brother.
Tax free. We like that. Tax free.
Yes.
All right. So, good people, as you know, I got to put my glasses on, quit fronting. Hey, man, we got a lot to talk about. We're going to get into what's in the new Trump plan and all of this. But before we get into that, a lot of people always ask me the same questions because we got new people that come in and join the family and they just don't know. All right. So let's just open up by talking about capital gains, right? Let's just start right there because I know a lot of people need to know. There's people doing options, there's people doing swing trades, there's people
Mhm.
that are long-term investors, okay? So let's talk about the differences in tax brackets.
Absolutely. So there's a major difference between short term capital gains rates and long term capital gains rates. And I think that if you're going to be investing, it is absolutely vital that you understand the key differences. So, number one, the IRS deems an investment to be short term when you hold your investment less than 12 months. So, if you hold an investment for 11 months and 10 days, that's still short term capital gains. And however, when you hold an investment for longer than 12 months, the IRS considers that to be a long term capital gain. And long term capital gains have more favorable rates than short term capital gains. So, short term capital gains rates are the same as ordinary income tax rates. So they go from zero all the way up to 37%. So depending on how much you earn with your active income, you could be paying 37% taxes on the money you earn from investments if you hold those investments less than a year. Now, let's look at the other side of that long-term capital gains tax rates, which if you hold your investments for 12 months in one day, the rates aren't 0 to 37%. The rates are actually 0 to 20%. So you can see a 17% tax rate change by simply holding your investments for longer than 1 year. So when I'm talking to investors, I always encourage them to think about before you're about to sell that investment, is there a possibility that you can hold it longer than 12 months? Because you can save massively on taxes if you do so.
Yes. So at the end of the year, you hear a lot of people talking about taxes, that type of deal. You hear me talking about it. A lot of people do a lot of tax loss harvesting at the end of
Yes.
the year, and that is why. But he said one thing I want you guys to remember: a year and a day. Okay?
Yes.
Right. It's not what you make, it's what you keep. For those that, hey, let's just talk about these kids. For those
Okay.
that are smart enough to start a business and employ your kids, okay? This has nothing to do with your investing tax bracket. This is different. We have a lot of
Mhm.
people out there with businesses, right? But
Yes.
they don't really know that they can be paying their kids and they can be writing that off. Then, on top of that, I'll talk about this piece. They can be actually investing it for their kids in a Roth IRA. So, talk about ages of where they can hire their kids and how much do they get to write off the business.
Yes. Wow. This is one of my favorite strategies, Larry. Thank you so much for bringing this up. So, when you have kids, the IRS allows you to hire your kids into your business. Because what most people do, they make money, they pay taxes on the money, and then they use the extra money to buy stuff for their kids. When I think we're doing it wrong. We should make money, hire our children into our business, pay them in a tax-free manner, and then they can use the money that we pay them to buy the things that we're going to spend on them anyway. So now we get to give our kids pre-tax money versus giving them post-tax money. And if you do this strategy alone, like you'll be able to, like, you'll help your family march towards generational wealth so much faster. So let me break down the strategy. So when you have a business, the IRS allows you to hire your kids into your business, right? And a lot of people do this. Like Rihanna does it for her Fenty business. Kim Kardashian does it for Skins. They put their kids in a lot of their advertising, so they hire their kids into their business. If you do this, the IRS allows you to pay your children up to the standard deduction 100% tax free. This year, in 2025, the standard deduction is $15,000, which means that you can pay each of your children up to $15,000 per year. You, the business owner, get a tax deduction, just like you get a tax deduction for paying any other employees, and your kids receive the money completely tax-free. No federal tax, no state tax, no FICA tax, no state unemployment tax, no federal unemployment tax. They get the money 100% tax-free. So we call this in our firm an income shifting strategy. How do we move money off
Right.
of your high tax bracket as a parent and move it to somebody else's low or potentially 0% tax bracket in the strategy of paying your children? So now we just moved $15,000 from 37% to 0%. And you can do this for each child that you have. So if you have 3 children, that's $45,000 of tax-free dollars you just gave to your children. And
Right.
now they can use that money, to Larry, to your point, to start their investment journey.
Yes. And so some parents choose to start to pay for college early, but your
Mm-hmm.
kid may not be college material. Let's just call it what it is. So
Yeah.
I like to start first with a Roth IRA for your child. You could, if they have a pulse and a social security number, you could start them a tax free vehicle, investing that money up to $7,000, even for that child, even now. And of course, they keep raising it. I remember back when it was 5,000, I was 7,000. If you're over 50 and a half, it's 8,000. So they allow you to catch up, good people. So this is what you want to do to start that generational wealth. Okay. Let's just talk about a vehicle. We've covered these before. He's been on this page before. So if you are doing a lot of running for your business and it's just eating up your car and you need a new
Mm-hmm.
car, but you're doing the majority of running for your business, tell them what should they do.
Yes. So one of the biggest misconceptions, Larry, that I see people make, and the mistake they make in their taxes when it comes to their vehicles, is they believe that the vehicle needs to be in their business name in order to write it off on their taxes. And that could not be more false. Okay. The IRS is not concerned about whose name the vehicle's in, whether it's your personal name or your business name. What the IRS is concerned about is, do you plan on using this vehicle at least 50% business use? If
Yes.
that is the case, you can write off that percentage of all expenses related to your vehicle. So let's say a common person at home might use their vehicle 70% business, 30% personal. Great. You now can write off 70% of the interest on your car note or 70% of the lease payment, whether you lease or own. You can write off 70% of the gas, repairs, maintenance, oil changes, licensing fees, parking, all expenses associated with your vehicle, you're able to write off according to that percentage, including one of my favorite expenses, which is called depreciation. So we all know, whether we know it or not, you're gonna find out right now, a vehicle is a depreciating asset, right?
Yes.
So the IRS says, you know what? Because you bought this depreciating asset, we're gonna give you a tax deduction today for when the vehicle loses value in the future. So you are able to also, on top of the actual expenses that you pay out of pocket for your vehicle, you also able to write off depreciation of your vehicle, which you didn't have to pay for. So in
Right.
an example, let's say you got a vehicle that was less than 6,000 pounds, but it was like $40,000. Even if the vehicle doesn't weigh 6,000 pounds, what most people don't realize is with just basic 179, you can still write off up to $20,000 in depreciation the first year that you purchase the vehicle.
Right.
Right. So, and that's if the vehicle weighs less than 6,000 pounds. If the vehicle weighs over 6,000 pounds, you can write off a lot more. So if you use your vehicle in your business, it is vital that you understand how to write off the expenses associated and how to take advantage of depreciation, especially if Donald Trump new tax bill gets passed. We're going to see a huge increase in the amount you're able to write off on your vehicle via bonus depreciation.
Just before we get to that, let's talk about crypto. A lot of my followers are buying crypto. We've been buying it for years. We're making a killing on crypto, but
Yeah.
some are leery about taxes. Should I sell? Should I take profits? Or can I continue to hold because I want to hold Bitcoin until it turns to $1 million, but are worried about taxes? Tell them what's going on with crypto and taxes.
Yeah, don't be worried. You don't have anything to worry about. A lot of the same tax laws that apply to stocks apply to crypto. If you don't sell, there is no taxable event, right? So if you're in this crypto game for the long haul, which I think you should. I'm there. I'm sure you agree with me. You should be in this,
Absolutely.
if you're in it for the long haul, there is no taxable event. If you buy $100,000 worth of crypto and you got $1 million worth of crypto at the end of the year, it's not a taxable event as long as you don't sell. So if you long as you hold on to your investment for the long term, you won't need to sell. And some people are like, well, what if I need the money? Well, that's where being able to borrow against the value of your portfolio, whether it's a crypto portfolio or a stock portfolio or a real estate portfolio. The secret of the wealthy is they never sell their investments.
Right.
They buy, they hold, and they borrow against the value and use that tax-free borrowed money for the things they want to pay for.
Because it's a
And if you keep
non-taxable event.
because borrowing from the value of your portfolio
Yep.
is a non-taxable event. So if you're holding crypto, hold it, and if you need to leverage the money, borrow against it. Now you want to be careful because you don't want to borrow too much of the portfolio, because if it goes down, you could be margin call. But you do want to, if you have plenty of equity, you can borrow that money instead of selling, and use that tax-free money to do the things that you want to do on a day-to-day basis. Now, another point of crypto
Yeah.
is, let's say crypto goes down and you bought at the top, and at the end of the year or towards the end of the year, your portfolio is in a negative. What I would recommend you take advantage of is tax loss harvesting, Larry, because it was interesting with tax loss harvesting versus stocks. If you try to tax loss harvest with stocks, which simply means that you sell and you lock in your losses, with stocks, you have this 30-day watch sale rule. So for 31 days, you can't buy back that holding.
That's what that W is beside
Yeah.
your stock, good people. That's a wash sale. That simply means that you sold it for a loss and you tried to buy back in less than 31 days. Sorry, go ahead.
And absolutely, right? So we have this watch sale rule which says if you sell, you can't buy back for at least 31 days. Crypto doesn't have that rule yet. So if on December 30th, you want to sell your Bitcoin because you're at a loss, and then on January 1st, you can get right back in the position and lock in that loss for last year, but get right back in position to ride the wave for next year. So one thing we tell our clients is review your crypto portfolio before the end of the year. We can sell out any losses on December 31st, buy it back the next morning, and lock in that loss and use that loss against other capital gains.
Now, one of the things I will say behind it, listen, you need to listen to your tax professional as it comes to crypto. New York has its own laws, so we're just giving you a framework, but you need to check with your accountant to see
Yeah.
what you should be doing in your situation, right?
1,000%.
All
1,000%.
right. So this is my man Carter Copefield. He is a tax strategist. Okay. So
Yes.
I think everybody needs a CPA and a tax strategist. That's what I believe. Okay. You need both, right? Sometimes they're both in one. But remember, good people, there are some accountants that we get to do our taxes, and they took
Mhm.
a course and they don't know any of the laws, right? They
Mhm.
don't really know how to be a strategist. So they're just
Yeah.
giving your money away to the government. But then you have a strategist look at it and they go, oh, we could have saved you this, and this, and this, right? And so that's why I suggest that everyone just look into a tax strategist. You want to add to that?
Yes, please. I think most people don't realize there's a difference between a tax preparer and a tax strategist, right? And I honestly think it's not fair to ask a tax preparer to give you tax strategy because their job is to prepare your taxes.
Yes.
But what you need to understand is that like you should get a tax strategist because most tax strategists have tax preparers in their firm that can do the preparation as well. So like when I look at a tax return, I'm not looking to file it. I'm looking at how can we save more money.
Right.
Where a tax preparer is just looking at where do I want to upload this document so I can give you what you're going to owe. The easiest way to understand the difference, a tax preparer tells you how much you're going to owe. A tax strategist tells you how much they can save you. It's that simple.
What's in some of the things that's in the new tax bill, Trump's tax bill? Go expound on that, please.
Yeah, so Donald Trump's big, beautiful bill is a new tax proposal that has made it through the House and made it through Congress, and I believe it has to go through Senate for it to get passed, right?
Mm.
So we're one major step away from it getting put into law. So I think it's extremely important that Americans everywhere understand the ramifications of this tax bill. So I'm gonna just highlight some of the things that stuck out to me, and then we can dive deeper if you want. Number one is no tax on tips and no tax on overtime pay. So if you work in a restaurant or you work in a bar and or whatever venue, and most of your income is paid via qualified tips, you won't have to pay taxes on those tips. Same thing with overtime pay. A lot of working people, when they get paid overtime, they get excited and do they see how much taxes is taken out of their overtime? Because what usually happens is overtime pushes you into a higher tax bracket and more taxes are taken out. So what the plan is proposed to do is eliminate taxes on overtime and eliminate taxes on tips. So a lot of Americans can be seeing a lot of tax savings if this bill get passed. Now let's talk about business owners, right? Because it's a lot of amazing things in this bill for business owners. Number one being the potential, not just a resolution, but backdated resolution of 100% bonus depreciation. So what I mean by that is currently, if you were to buy a vehicle or any piece of equipment or real estate property, and that property or vehicle weighed over 6,000 pounds, you can only write off 40% of the value. So let's use a car. If you bought a car that weighs over 6,000 pounds and it was a $100,000 car, you can only write off $40,000 worth of that 100,000 this year. Last year it was 60%, meaning 60,000. The year before it was 80%, right? So it went down year over
Wow.
year. But
Yep.
what this proposal is saying, though, Larry, which is very what I think is it could be amazing, is not only could bonus depreciation go back up to 100%,
100.
but it would work retroactively. So you can go file an amended return for last year, and instead of taking 60%, you can get your 100%. You can go back to 2 years in the past, and instead of getting your 80%, you could get back your 100%. So it wouldn't only be reinstated for this year, it'll be reinstated for previous years, leading to major tax refunds for business owners everywhere.
Right. Guys, I know you're saying, but I don't like Trump. This is not what this
Hey,
is about. Right, right. That's your thing. We get it.
yeah,
We're just don't shoot the messenger. We're just telling
yeah,
you some of the things that are good in the bill. Just like any bill, Democrats or Republicans, there's good and there's bad and there's pork in every bill. I understand. Hey, how is that going to be paid for? That's not what this show is about. He's just telling you what's in the bill. All right. Now that we got that straight, hey, before we talk about what Grant Cardone did for a major tax write-off, because he's a tax strategist, let's talk about your event that you got coming up. I was there last year. I was blessed to be nominated for Influencer of the Year. And people, let me tell you, I'm going to show you some clips while I'm talking. Let me tell you, you see, this place, it was like walking into the Academy Awards or the the ESPYS or the Grammys. I mean, they had this place lit. I was like, what? When I walked in. And so it was, drum roll and the nominees are. And I was just like, wow, this is really cool. Tell them what's going on and how they can participate.
Yes. So the Melanin Money Awards, it'll be the third annual Melanin Money Award show, and the whole purpose of this award show is we want it to be the Grammys of financial literacy. Right? We have so many amazing people, just like you, Larry, in the space that teach about stocks, crypto, real estate, wealth building strategies through insurance, trust strategies, personal finance, budgeting, debt, all these amazing influencers and experts that help bridge the gap of financial literacy where our school system has failed us. And so what we decided to do is to bring all those top experts and put them in the same room and award them for the work that they do, right? So last year you were nominated for Stock Market Expert of the Year because you're an expert at what you do. And we have, I believe, 100 plus different financial influencers, experts, coaches, advisors. And if you love financial literacy, you want to learn more about financial literacy, or you want to meet your favorite financial literacy expert, the Melanin Money Award Show is the number one award show for wealth building, for financial literacy. And I'm proud to say that you're nominated again.
Oh, wow.
So I can't, yes, I mean, I'll tell you on the show. Yes, you're nominated again for the amazing work that you're doing, man. So we just, encourage everybody who wants to learn more about financial literacy and get in the room to grab a ticket, obviously, to learn. We're going to have education before the award show. So we have some education pieces implemented, but we also have that show where they will be able to learn and get to meet some of the biggest people in the financial literacy space. So I'm excited and I can't wait to see you again there, brother.
Man, it would be a pleasure. I had a great time. Hey, guys, come out and meet your boy. I'll be there. Let them know the date, and it's in Atlanta, correct?
Yeah, yeah. So it's July 18th and 19th in Atlanta, Georgia. And what I'll do for you, Larry, is I'll give you a link and a special promo code for all of your listeners. So I think I told the team 25% off of all tickets. So
Yes.
you have a special promo code just because, I love what you do for the community. I see what you do. You post a video every single day. So I want to gift your listeners with that if they want to come learn more and obviously meet you in person.
Hey, that's cool. Hey, good people, if you want to meet me, I will be there. I will be in the place. I want to see your face in the place, as they used to say. All right. Hey, I'm going to leave a link, the top link in this video. Just click down to the description. The top link in this video will be where you could get 25% off of the ticket price and come and learn. Hey, small businesses, you need to be there. If you want to start a business, you should be there. And last year, I remember they even rewarded businesses. They were cutting checks to businesses that
Yeah,
were
yeah,
not even
yeah,
expecting it. I thought that was really cool. I'm all
yeah.
about giving back. I love the way you guys were blessing these businesses, and that was really cool. So I'm looking forward to it.
Yeah, this year we're doing a $15,000 investment portfolio giveaway. So we're going to give one person the $15,000 investment portfolio at the event. Again, just to like give back and help the people understand that
Yeah.
they're worthy of wealth, right? Which is big.
Hey, man. So I was at the Bitcoin conference, and
Talk to me about this. Yeah, please.
I was talking to Forbes magazine. We were just having a powwow, and when we got through, Grant Cardone literally just walked right up to me. Hey, how you doing? I'm like, hey, how you doing? I mean, the place was packed, and he began to talk. uh, you know, he's very controversial. I'm gonna be nice, and so I can't even air most of the stuff he was saying. But there was a clip about a tax strategy, how he got to not pay taxes. Go ahead and talk about that, and then tell them how he beat out a huge tax bill.
Yes. So Grant Cardone is a one of probably one of the wisest um, investors when it comes to tax strategy. Like he's a real estate investor, but like he knows more about tax strategy than a lot of CPAs and accountants. So what Grant Cardone learned about is the power of bonus depreciation, right? So as I mentioned earlier in the episode, bonus depreciation on any piece of equipment that weighed over 6,000 pounds was 100%. Meaning, if you purchased a piece of equipment or asset for your business without using your own money, you can still use a loan. You
Right.
get to write off 100% of the value of that asset. So what Grant Cardone did is at the end of the it was the end of the year, he was looking at a huge tax bill, right? He had millions of dollars in profit from all of his ventures. And he said, I don't want to cut the IRS a big check. So he then called a few private jet hangars and said, I need you to sell me a jet before the end of the year. And he found one that was willing to finance him a jet before the end of the year. He paid the down payment for the jet. It was a $63 million jet. He didn't wire them $63 million. He paid the minimum down payment for the jet. And what he got in return was he got a $63 million tax deduction for bonus depreciation on that jet. So here's what that jet did. It not only, Larry, it not only wiped out his tax bill for that year, but
Carried over.
because the jet was so expensive,
Yeah.
losses that you don't use in the current year roll over into the future year. So I
Yeah.
believe he was able to avoid taxes for 3 straight years using this strategy, which is where the story comes from, and it just shows that whether you like them or not, controversial. That's up to you.
Right.
But
Right.
everybody can learn a little bit from this tax strategy.
Hey, I'll learn something from a dying dog that just bit me. Let me tell you something. If there's a lesson to learn, I want to learn it. Let me just listen. Always, my grandmother used to say, "You got to get through the shucks to get to the corn." All right, so let's just go there. Hey, man, I'm going to end it right here. A wealth of knowledge. Always, when you come here, you're dropping gems. Anything you want to say in parting?
Yeah, the like one thing I'd like to love to tell people, and I'll tell your audience this as well. The easiest way to make more money is to pay less taxes. Like you don't got to ask for a raise, you don't got to get more clients. If you just go from paying $40,000 in taxes to paying 10, you just put $30,000 back in your pocket. And so one thing I just want to leave you all with is that the most expensive tax you're paying is not federal tax, it's not property tax, it's not state tax. The most expensive tax that most Americans pay is what I call the ignorance tax.
Wow.
The tax for not knowing how to legally avoid paying taxes.
And then I'm going to end with this. We can cover this in 30 seconds. Listen, if you start out, you got a window washing company, or you selling eggs, you reinventing the milkman, and you start to make more than $50,000. When you first start, the first couple of years, 10,000, 15,000, little side hustle. Now it's growing. Now it's over 47,000. Now it's over 50,000, and you're still an LLC. What should they do, Carter Cofield?
They should convert that LLC to an S corp to start immediately saving on taxes.
Because they're going to pay a much lower tax rate. There's so many things, and there's people out there that are listening. You're going, oh, that's me. I didn't know that. There's so many things, like the difference between a bonus check and a distribution check. Okay. When you write yourself a bonus check under an LLC, if it's just an LLC, now you got to pay taxes. But when it's a corporation and then you take out a distribution, it's a little different. I'm going to just leave it at that. All right, good people.
Yes, sir.
Yeah. Hey, man, it's always a pleasure talking to somebody that is a tax strategist and constantly helping the people. Look, the top link below in the description will be the ticket to this event with a 25% discount just for you. All right, good people. Live, love, laugh, and learn. We'll see you on the next one.